First item of business is the agenda. Excuse me, it's the approval of the minutes of the March 24th meeting. These were all passed down last week. Kathleen, do you have a comment? Or
nope. I just said it's all in favor.
All in favor, say aye.
Aye.
Okay. Janet.
As you know, the last time we met, approval was given for the hedge fund allocation and 2 new managers. That was implemented, and since then the market has gone down. So hopefully we'll see the defensive nature of the hedge funds in the report today. I'm sure we will. And with us today is Thomas Schmidt-Jeppesen from Cambridge Associates, and he's going to review our performance and talk about a minor change in our fixed income asset class.
So if you'd all turn to the one called page 1, called Capital Markets Overview, just to give you a little sense of the markets before we go into actual performance, give you a good background for that. And we've shown you this particular exhibit before, but in this case, I think it's even more telling about where markets are, because the first up in the top left-hand corner shows this recovery that we've seen since March of 2009, and that seems to be going. The economy is improving. We are seeing the growing GDP, and I have been pulling out of that slump. But the top right-hand corner shows you that the T-bill rate is still very low. The stimulus is gradually being withdrawn, but the interest rates are kept very low because there's still this. If we move too fast on raising interest rates or pulling stimulus from the economy, will we then kill the same recovery that we're trying to generate with it? And there are genuine concerns about that, about the growth in the second half. We are seeing some pullback. I mean, the housing market help that's been given both by purchasing mortgages and also by the first-time home buyers credit have now been withdrawn, and the implications will be seen here in the coming months. So there is some things about that, and obviously it's a fine balance. If things are being withdrawn too fast, recovery might get in question. If they get withdrawn too slowly, too much money, liquidity is in the system, and that could create bubbles. So it's a very fine balance that the Fed and the government is walking here. Oil prices had been coming out of the deep hole that they were in back in March of 2009. And had been growing, had been going up since then. But May saw a pullback in that, since the whole sort of economic recovery of the entire world was sort of brought a little bit into question, and especially obviously the European. And we'll talk more about that. And then finally, the European versus yen is obviously the story that in this second quarter has dominated the headlines and has been the catalyst of the market turmoil we saw in May. If you look briefly on page 2, you can see that then the quarter-to-date returns, so that is from April and until the end of May, were in the red. April was a positive month, but May was a very negative month, and so actually brought the year-to-date numbers for equity down below 0. And then the trailing 12 months is obviously still very positive, driven by the strong returns we saw in 2009. So the long-term story, or the sort of longer-term story, is still more positive than the shorter-term story. And then, as we talked about, the big news for this quarter has been this European debt crisis. Now, it was always something that was looming as we exited the first quarter, but certainly it took root and blossomed, the European debt crisis, with a lot of focus on what they call the PIGS countries, so Portugal, Italy, Ireland, Spain, and Greece. But now, the whole European construct is being called somewhat into question. At least the euro construct is being called into question. Big divergence between the sort of richer countries in Europe, the core European countries of France and Germany, and their fiscal and budgetary situation, and then those in the periphery countries. And that divergence is creating some severe strains within Europe. But while that was the catalyst for the turmoil, it behooves us all to remember that this is not just a European problem. Longer time, we're seeing that UK has the same kind of issues, and even US have high deficits and Japan has very, very high debt to GDP. Now, the difference between the Eurozone countries and these countries, the UK, US, Japan, is that the Eurozone countries have less tools to work with, given that they can't freely devaluate their currency, which UK, US, and Japan theoretically could. Right. Yes?
Thomas, the top chart, the deficit as a percentage of GDP?
Yes.
Can you pick a country and
yes. So we have. So let's take for instance Greece, which since that was where the whole trouble started. So the blue bar we have shows that in 2008 the deficit was around 8%, maybe 9% of GDP. In 2000,
it says negative 8%.
Negative 8%. Yes.
Meaning that if the GDP was 100, their deficit was 8, or was 108.
108.
No, it was 8%. 8% of the GDP. So
8% of the GDP.
Yes, exactly.
So that if they had a budget surplus that was equal to 8%, it would be above the line.
Exactly.
Right.
Exactly. And so this as you can see, there are
the budget guys are like looking at this and there's something wrong.
I'm sorry about that.
No, that's okay.
But remember that in EU they've had a sort of a magical limit of 3% that was called sort of the tolerable level of budget deficits,
Right.
and you can see here that these have been blown through by all these countries. And the reality is just that in 2008 the crisis fostered all these stimulus programs, actually less so in the Europe than in the US and China and Japan, and so almost all countries have had to run much higher fiscal deficits, but the accumulation of fiscal deficits is obviously what then generates the debt to GDP ratio you see down here below, which ultimately will be the thing that people have to worry about, because the interest rates on those debts might, if growth doesn't return, might really be the ultimate thing that comes home to roost. And this is true for the US as well as the UK, as for Europe, that if something is not done, and again, this is what is done and what the timing of it is. If something is not done, then something in the future might come down the pike. So all in all, leading us to page 4, which is sort of our valuation summary. You've all seen this before. And the story is pretty unchanged in that from the last time you saw it, there are not many compelling valuation opportunities out there in terms of deeply undervalued things, which basically tell us that we should stick pretty close to our target allocations. There's not a lot of room for tactical positioning in the current environment. Unlike in 2009, where we saw a lot of opportunities that kept us, for instance, in active bond management, kept us in convertible bonds, kept us in some of those areas that we benefited from, but those opportunities have largely played out now. Any questions to the market update? If that isn't so, we can go to page 5 with the performance. And here you can see we have the asset allocation. A couple of you should all be familiar with this. This is obviously the target allocation versus the actual allocation. And you can see here in the bottom chart, there's a couple of new things. As Janet pointed out, we have now incepted the hedge fund portfolio at 10%. With the hiring of Archstone and Evanston. And so that one has now been populated, whereas the non-marketable, as we discussed in our March meeting, is still something we have to discuss at some later time. Now, the lack of funding for the non-marketable then, in turn, makes us overweight U.S. and non-U.S. equities, as you can see here. But there is a slight underweight currently to fixed income, and that's something that we've discussed that we should rebalance in order to get that up again. The absence of compelling opportunities makes it wise to just stay close to the target allocation. So we should rebalance to regain the 25% in fixed income, and we'll just do that by taking a little money out of the U.S. equity. Jumping a couple of pages to actual performance on page 9. You can see on the bottom line here that the total portfolio has returned minus 2.5% calendar year to date through end of May. Now June has, at least until today, has been in positive territory, and we tried to calculate just back of the envelope yesterday, and it looks like you're sort of flat for the year. But again, June is not over, and so second quarter could still turn either positive or negative depending on where markets are heading from here. A couple of sort of more details here. You can see your equities have actually generally outperformed their indices. And then your fixed income is underperformed, and that's where in a relative sense you are pretty close to your policy benchmark, which as you recall is basically the asset allocation weighted target with target weights. If we go a little more into detail, just highlight a couple of managers that did either exceptionally well or not quite so well. On page 10, you can see that Philadelphia International had a good May in a relative sense, not a good May in an absolute sense, but that was slightly encouraging in that they had underperformed for the year versus their index so far, but May they actually regained some of that lost ground, even though obviously on an absolute turn it was a pretty dismal month. The Walter Scott continues to outperform. The reason for that is that they have this Japan dominance, which obviously in a world where the euro crumbles has been a positive, not just for the first part of the year, but also in May. Still not good absolute returns, but at least in a relative sense that does help a little bit with the outperformance over the index. The whole international sector has obviously again been impacted by the euro issues and the fact that the euro has dropped against the dollar. In emerging markets, Aberdeen continues to outperform, and it's encouraging that they outperform not just in the positive months of April and March were positive months for the emerging markets, but they actually also outperformed in a negative month like May. So that is encouraging, and as you can see, since inception they have outperformed by 8.5% annualized, which is quite encouraging, and obviously something we like to see. The two managers, Archstone and Evanston, they've only been in for a month, so it's hard to talk about anything really meaningful. But they both outperformed their index for that month of May. And finally, and I think it's worth mentioning, of course, that hedge funds. I mean, our timing here, and this is more luck than anything else, but our timing was actually pretty good. We got them in at the beginning of May. And obviously they protect in a down market. So where equity markets were down 6% and the international equity markets down somewhat more than that, the hedge funds were down only 2 or 2.5%, and that is encouraging. Wellington, with their energy exposure, obviously got hit by the downturn in the market in May, but since inception they've still outperformed their index and have actually produced quite solid returns. And then finally, the fixed income, and we'll talk more about that in a second. You can see that they underperformed, and this is very much. We think it falls in line with the fact that we kept the active management of these managers for 2009 simply because there was a good opportunity, especially in credit in 2009. But by this time, the credit spreads have come down to the point where there's not much opportunity for active managers to add value, and that is obviously reflected in Neuberger's comment here. You will remember that we used to have a manager called Oppenheimer. They actually, if you will, self-terminated in the time since our last meeting. Their entire fixed income team went to another firm that required relatively fast action, and so in conference with staff, we terminated the manager and rolled the money into a fixed income index fund, the State Street Government Credit Fund. And that's obviously, unless there are any questions to the performance, that's a good segue into our sort of decision point of the day, which is whether we should terminate the remaining actively managed bond manager in favor of this index fund.
Yep.
The argument is
I think that's a yes.
Well, because I said, yep.
Just briefly, the background here is obviously that back in when we did the investment planning review back in 2008, it was the plan there to go to an indexed management of the bond portfolio. The core of it is that over longer term, active managers just have a hard time, especially core managers that don't have a lot of leeway in what they can do, have a very hard time outperforming the index without taking on excessive risk or just risk that we think are unwisely placed in that part of the portfolio, which is your hedge, if you will, or your anchor to the windward. And you can see that in the performance of your fixed income portfolio since inception back in 2000 when we started tracking it, has underperformed a passively managed bond portfolio. Mm-hmm. And so that is basically the rationale for the recommendation to terminate the remaining fixed income manager, active fixed income manager, and rolling it into the index fund. There's obviously also a fee element to it. You're currently paying close to $100,000, or at least were when you still had Oppenheimer and Neuberger Berman. You were paying close to $100,000 in fees. That will be reduced to somewhere between $15,000 and $20,000. So there's an $80,000 savings already there. And again, in terms of where you want to take your active management risk, we just don't think that the fixed income portfolio is a sensible place to take it. And so we suggest that you take the current active manager, terminate that, and roll the money into the government credit fund from State Street that we hired to replace Oppenheimer already.
We want to discuss doing that before,
I'm fine with it.
Professor Phillips?
I've got a related question that may possibly bear on it. How much risk do we have in the fixed income funds in the event that perhaps the general interest rates might at some point in the future rise?
That's a very good question, and there is interest rate risk in any bond portfolio. That would be the case both with the actively managed bond portfolios as well as the passively managed bond portfolios. In general, and it gets a little more complicated than that, but if you say that the duration of a fixed income portfolio is around 4.5%, that indicates that for every 1% rise in the interest rate, then your bond portfolio should decrease by 4.5%. Now, the math gets a little more complicated because nobody can ensure that it's a parallel, and there's a lot of complications there, but that's sort of your ballpoint estimate of the interest rates embedded in your portfolio.
So can active management reduce that risk?
It depends on the active manager. Some managers will play on duration, but most of them will mainly play on credit, where they will try to take some credit risk and reduce their treasury holdings in order to hope to pick up some yield. So that's the standard, if you will, of active management. But there are some managers that will take or try to reduce the interest rate risk.
Do we know what the duration is of the State Street Fund, how far out it is?
I think it says on the duration is 5.3 on the State Street of Global Advisors. It says on the last page, page 19. And this is as of March 31st. It might have moved a little bit since then, but I wouldn't expect it to have moved much. We can certainly go into details with the government credit index if you're interested. There are basically two popular index choices, if you will. One is the Aggregate Index, and another one is the government credit index. The Aggregate Index is different from the government credit in that it includes mortgages, whereas the government credit is treasuries basically and some agencies, and then the credit bonds. There are pros and cons of having mortgages included in the portfolio. In some situations, it will dampen volatility, give a little bit extra yield, but especially in a rising interest rate environment, they can actually come back and haunt you a little bit because the prepayments dry up. In a rising environment, there's nobody who wants to refinance in a rising interest rate environment, and so the duration actually tends to go up in that. It's called convexity, and that's again, a somewhat complicated but important factor when you think of these things.
Bring it to a vote. Any other questions? Have a motion?
So, yes, my
Second,
motion.
all in favor? Aye.
Okay.
Carried. Sorry? The motion is to approve the removal of Newberger Berman and replace them with State Street's
Indexed.
index fund. Here, it's right here. I'll show it. Send them.
That was all I had.
What's our, I have a question, what's our exposure in the, I guess, to the oil companies and natural resources right now? Couldn't find that.
No, I mean, if you're talking specifically about the companies that are in the that are involved in the BP oil spill, if you will, there is some exposure. I mean, just the fact that you're holding the Vanguard ETF, for instance, which is a broad market index, will give you exposure to companies like BP. The same thing with holding the Russell 1000 will also give you some exposure to some of the others. It's not a big exposure. I don't have the exact numbers, but you will have some exposure to those companies.
Is it listed as a domestic or an global?
Well, BP, it depends, because BP is obviously, not obviously, but it's a UK firm, so that would be included in the EFA index, whereas some of the others like Anadarko, the Transocean are U.S. companies.
I could look at our quarterly report, which details the holdings, and let you know what our specific holdings are with BP and Transocean and Anadarko.
That'd be great.
I'm sure in light of the situation, the portfolio manager will be, moving out of it.
Well, that's a complicated question. There are some managers who think that the stocks have been unpunished. There are some managers that are buying it right now, that haven't had it before, that are buying it right now. I talked to a manager in Boston just last week that were buying up because they say that the stock price dip is exceeding the potential cost. Now, obviously, it's anybody's guess, and people have different positions on it. So, but your exposure would mainly, maybe not exclusively, but mainly be through your index funds, where there's really not much you can do. The indexes are forced to hold whatever is in the index. They can't really make either pro or con bets. So that exposure is sort of a guaranteed. Wellington may have some exposure there too. I'm not quite familiar with what exactly their exposure, but we'll look into that and give you that detail.
Motion to adjourn? Thank you.
Joe, we're meeting again in August?
I can work on that.
Joe?